So starting with the new concept called technical analysis. Just giving you once again an explanation that I already have provided to you earlier, that this technique says that what is name of the company, I am not concerned. Before how many years the company was formed, I am not concerned. What is the profit, I am not concerned. Assets, I am not concerned. Industry, I am not concerned. Type of business, I am not concerned. I am not concerned with all these things. I am concerned with only one thing. That's what is the current price and what had been the price of the security in past. That's it. I had given you an example like this, that the price of the security is going like this, coming down, 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 and so on. So basically what happens, that say you have like a rough idea that the prices are going in this direction. The prices are going like this. Rough idea. We understand that of course it is not always going to be like that. However, we can say that say if at all it has gone in this direction now, definitely the price of the security now will go up for some more time and then it will surely fall down. So this is not the point at which we should buy. Rather, if at all you are holding it, then in that case, say at this point of time you should sell it. And this is what say we understand is the technical analysis. So you just take into account the price of the security, and based on that say you make an estimation that say what will be the future direction of the security. That is the technical analysis. So we are going to have certain discussion with respect to the technical analysis. Technical analysis is a method of share price movement based on the study of price graph or chart on the assumption that share price trends are repetitive. So whatever happened in past, the same thing is going to repeat in future. Since the investor's psychology follow a certain pattern, what is seen to have happened before is likely to be repeated. The technical analysis concerned with the fundamental strength or weakness of a company or an industry. He studies the investor and the price behavior. A technical analysis attempts to answer the two basic questions. Is there a discriminate trend in the share prices? If there is, then are the indicators that trend follow that is would reverse? The method used to answer the questions are visual and statistical. The visual methods are based on the examination of the variety of the charts to make out patterns, while statistical procedures are analyze the price and the return data to make the trading decision. So we are going to have understanding that say which kind of charts are there and how we can draw the conclusion. Before going further, I would like to give you certain overview of the entire working. We are going to understand a few assumptions based on which the technical analysis work, the principles of the technical analysis. There are certain theories which have been developed for the technical analysis. We are going to study three of them, three theories that we are going to learn. Then charting techniques, how chart is prepared, no interpretation, how chart is prepared. We have line chart, we have bar chart, we have Japanese candlestick chart, point and figure chart. So these are the four charts. So how it is prepared is only explained to us. With that say what kind of conclusion is to be drawn is explained later on. Market indicators. So these are certain ratios which are supposed to be calculated based on some information. So breadth index, five kind of set indicators are there: volume, transaction, confidence, RSI. You might have heard about it, relative strength index, and odd lot theory. Then say we are having say these kind of say the explanation with respect to the conclusion based on the charts. That is support and resistance level, interpretation of the price level, that is the price pattern. So whatever the charts that you draw, based on that say what kind of conclusion that say you can draw is what they have explained over here. So it is channel, wedge, head and shoulders. So it is, this is shoulder and this is head, head and shoulders, inverse. So this is head, this is shoulder, inverse. This is head, I'm sorry, this is head and this is shoulder. I'm sorry. Triangle or coil formation, flag and pennants form. Triangle and flag and pennant. Double top, double bottom. So you can see that say the top, top, double top, bottom, bottom, double bottom. This is what say they've explained. Then data analysis. In that say the moving average. I was talking about the simple moving average. That is what yet we have to calculate. And exponential moving average. That is what say we are going to understand. Simple moving average and exponential moving average. Evaluation of the technical analysis. Whatever we have that is discussed. Difference between both of them. And then the efficient market hypothesis that we already have understood, say in doing that that is EMH, run test, autocorrelation test, filter test or residue test, something like that. So there are a few assumptions which have been made, and based on those assumptions we understand that say the technical analysis work. Of course we understand that say if at all the assumptions are not true, assumptions are not prevailing, then in that case whatever the transaction in which you have entered upon will not be able to give say a gain to you. I give you some more explanation. uh, in a simple language we understand that say when you purchase a stock you will be able to make a gain if at all the prices are increasing. It means that say if at all I'm expecting the price to increase, I'll buy a stock. In that case we will have a diagram like this. On x-axis I'm taking the spot price and on y-axis I'm taking the profit loss. This is a point that we cover more in detail in our chapter called derivative. Now friends, what happens that we understand this is your purchase price. You expected that the price of the security will be over here, but instead of that if at all the price of the security is this, then in that case of course you will incur a loss. So this is what the theory says. This is what the technical analysis assumptions say. Let's say whatever you anticipated, if at all, based on certain like the assumptions you are following the like the charting techniques, but if at all it does not prevail, then in that case you will not be able to make a gain. Assumptions: the market value of the stock depends upon supply and demand for the security. The supply and demand are actually governed by several factors which can be rational or irrational. For instance, recent initiatives taken by the government to reduce NPA burden of the bank may result the demand of the banking stock. Means we understand that say any of the information that say would be rational or irrational will have an impact on the demand of the stock. Stock price generally move in trend which continue for a substantial period of the time. Therefore, if there is a bull market going on. Bull means prices are increasing. There is every possibility that there will be soon a substantial correction which will provide an opportunity to the investors to buy the shares at that time. It says something like this. Friends, never stock market prices will go like this. The stock market prices are going like this. That is, say, even in case of the bull phase, that is, the prices are increasing. If at all you take the average, then in that case the average will go like this. With that, so you can definitely understand that, say, usually the prices are going up, but it will not definitely go up in this way. It will go up like this, and that is what technically given a name as you smoothening the fluctuation, and you get the average based on which you can take a decision that, say, in which direction the prices are going. Technical analysis relies upon the chart analysis, which shows the past trend in the stock prices rather than the information in the financial statement like balance sheet or P&L account. So these are the assumptions. The principles. The technical analysis is based on the following three principles. Market discounts everything. It means that whatever the information which is there about any of the company is always, say, fully incorporated in the current price of the security. It means that, say, if at all Adani company is going to get a good order, then in that case, so the effect of that is always incorporated in the current price of the security. If at all there is a heavy penalty on Facebook, then in that case, say, the effect of that information is always incorporated, so, on the current price of the Facebook. It means that, say, whatever the information, say, about all the securities in the market, it is already incorporated, say, in the current price of the security. That is what it says. That may be a good information, that may be an unfavorable information about the economy, about the industry. Means, let us say that, say, there is like the tax is required, that is the an industry like textile is going to be taxed, it is going to be covered in the GST, and the rate of the GST will increase. So effect of that will always be incorporated on all the stock prices of the textile industry. If at all there is a penalty or there is a good project that a company is able to get, then that effect is always there on the current price. So market discounts everything means the current market price is after taking into account all the information about the security. The price moves in a trend. So the past will always repeat. History tends to repeat itself. Uh, Market discounts everything. Although many experts criticize technical analysis because it only considers the price movement and ignores the fundamental factors, but efficient market hypothesis discussed later in detail contradicts its, according to which company's share price already reflect everything that has or could affect company and includes the fundamental factors. So technical analysis generally have the view that a company's share price includes everything, including the fundamentals of the company. B. Price moves in trend. Technical analysis believe that the price move in trend. In other words, a stock price is more likely to continue a past trend than move in the different direction. This is against the weak form of market efficiency. Okay, the weak form of market efficiency says that it is not like that. History tends to repeat. Technical analysis believe that history tends to repeat itself. Technical analysis use chart pattern to analyze the subsequent market movement to understand trend. While many forms of the technical analysis have been used for many years, they are still considered to be significant because they illustrate the pattern in the price movement that often repeat themselves. There are three theories that we are going to understand called Dow Jones Theory. The second is the Elliott Wave Theory, and the last is the Random Walk Theory. So, what is the kind of explanation of the Dow Jones Theory? Let us have understanding. Having some discussion before we read that. As per Dow Jones Theory, there are three types of market movement. One is the primary, next is secondary, and the last is daily. There are three types of, say, the market movements. Primary is for long term, secondary is for short to medium term, and daily is of course so on the daily basis. The primary movement will be, if it is bull, means the prices are increasing, then secondary will be bear, the prices are falling down. Primary is bear, that is the prices are falling down, then secondary will be bull, that the prices will go up. That is what we will have. Understand carefully. As per Dow Jones theory, which was introduced by Professor Charles Dow Jones uh, approximately in the year 1902, he believes that what will happen, that say initially for, that is say the four-sighted investors, that is say those who have say the good fundamental foresight say about which companies are likely to grow, what they will do, they will initially accumulate the shares, they will buy the shares. That is say the companies for whom say the prices are low, they go on buying the stock. In the initial phase it will like that is happen like this. In the next phase what happens, I'd say actually the performance of the company is say showing a good performance, and because of that so the prices of the security will further increase. Why? Because now the others will also participate in the stock. In the next stage what will happen, that say the foresighted or the like knowledgeable investors have come to know that say this company has reached to its peak. Now the price of the company will not increase much, or the company's profitability will not be maintained, so now they will sell the stock. That is what say the way say the uh, stock market will behave. So what you should do, you should be say recognizing that say which kind of trend is going on, and accordingly you should enter into the transaction. This is what say they say. That is say he has a kind of theory. Let us read this, keeping this in our mind. The Dow Jones theory is one of the oldest and most famous technical theories. It was originated by Professor Charles Dow, the founder of Dow Jones Company. You might have heard about the Dow Jones Index. It is after his name only. In the late 19th century, it is helpful tool in determining relative strength of the stock market. It can also be used as a barometer of the business. The Dow Jones theory is based upon the movement of two indices. Dear students, the term indices stands for, like all of you must have heard about the Sensex and Nifty. They are considered to be indices. It means that say the weighted average value of certain stocks, that is the indices. Constructed by Charles Dow Jones, Dow Jones Industrial Average and Dow Jones Transportation Average. Okay. I am giving explanation of these two words. Industrial means, let us say, manufacturing company, and transportation means logistic company. What will happen if at all the manufacturing company is having say the good business, then in that case, say they will require the transportation, and with that, so the transportation industry will also be able to get the business. So the price of these two stocks will move in the same direction. That is what, so the kind of the explanation that say he has given. These averages reflect the aggregate impact of all kind of information on the market. So if at all the industrial average increases, everybody is getting business, including the transportation. The movement of all the market divided into three classification. Okay, now the next explanation starts. Three classification means these classifications, all going in the same line. Primary movement, secondary movement, daily fluctuation. Primary movement is for long period, secondary movement is for medium period, and daily fluctuation is for, that is on daily basis, of course. The primary movement is the main trend of the market, which lasts for 1 year to 36 months or longer. So the duration for this is 1 year to 3 years, and it can be even more than that. This trend is commonly called bear, that is, so the prices are going down, or bull, that is, prices are going up. The secondary movement of the market is shorter in duration than the primary market, and importantly, you can see that it is in the opposite direction. Friends, over here, of course, you cannot have like the answering to this question in your own way. You have to give the answer that if it is bull, then it is bear. If it is bear, then it is bull. This is for the long term. This is for short to medium term. It lasts from 2 weeks to a month or more. So over here it is 2 weeks to 1 month or more. The daily fluctuations are narrow movements from day to day. That is daily fluctuations. I need not to say anything about it. These fluctuations are not part of the Dow Jones Theory interpretation of the stock market. So one of the explanation that he has given is that the daily fluctuations are not a kind of the analysis. So we can ignore it. However, daily movements must be carefully studied along with the primary and the secondary movement, as they go to make up longer movement in the market. But yet you just have to have an observation about it. Thus, Dow Jones' purpose is to determine where the market is and where it is going. Although not now, not how far or high, the theory in practice states that if the cyclical swings of the stock market averages are successively higher and successive lowers are higher, then the market trend is up and a bullish market exists. So what will happen? Listen me carefully. This is primary movement. This is secondary movement. This is primary movement. This is secondary movement. This is primary movement. This is what we understand is a kind of, this is the bullish trend and this is the bearish trend. This is bullish trend primary and this is bearish trend secondary. Reverse. This is primary bearish, secondary bullish. Primary bearish, secondary bullish, like that. So see what they have provided over here. The theory in practice states that if the cyclical swings of the stock market averages are successively higher and the successively low are higher, the market trend is up. So this successively lower is higher than this. This is what say they. This is successively higher and the successively lower is higher than this. Then in that case the market is bullish. And this successively higher is lower than this lower. Then in that case say it is bearish. The theory in practice states that if the cyclical swings of the stock market averages are successively higher and successively lows are higher, then the market trend up and the bullish market exists. Contrarily, if the successive highs and successive lows are lower, then the direction of the market is down and the bearish market exists. This is what we understand. And I need not to say that say these things are supposed to be as it is only. Now say going further, say initially accumulation phase, then we understand that say the reports of the company is good and the others will also participate, and then the prices have already gone to up and the companies are not going to perform great, so there is a distribution phase. So accumulation, participation and distribution, three phases will be there. Charles Dow Jones proposed that the primary uptrend would have three moves. Okay, so now it is further explaining to us. The first one being caused by the accumulation of the shares. By whom? By far-sighted, knowledgeable investors, those who are able to study the market well. The second move would be caused by arrival of the first report of the good earning by the corporation. So before good reports, you have forecasted that this company will do great. With the good reports of the company, now others will participate. Okay. So accumulation, participation, others will come. And the last move up caused by the widespread of the report of the financial well-being of the corporation. Now importantly read that the third stage would also see rampant speculation in the market. Rampant fluctuation means that it is out of control. Nobody is able to control the market. What is going on, nobody can understand. Towards the end of the third stage, the far-sighted investors realizing that high earning levels may not be sustained. Now this is the peak. Now the prices are not going to sustain. Now what they will do would start selling, starting the first move of the downtrend. So now from there the downtrend starts. And non-substantially of high earning is confirmed. The second move is further down would be initiated, and the third move down would result from the distress selling in the market. That is what they have provided. The next is the Elliott wave theory. Okay, wave is something like this. So basically friends, as far as the Elliott wave theory is concerned, it says something like this. They have provided that say total there will be like the prices are going up. How it will go up? It will go up like this. It is 1, 2, 3, 4 and 5. Okay, it goes like this. So it is going up and then it will come down. Again it will go up, then it will come down. Again it will go up. That is the way, say they will be like going up is like this. It will go up in this way. And then, listen carefully, it will go down. It will not go down immediately like this. Then again it will go up and lastly it will fall down once again. Yes. So it is A, B and C. Now listen carefully what I am going to tell you. Mr. Elliot made a research of last 75 years since the stock prices, and say in the year 1934 say he introduced this theory. He said that say the total there will be, we can say that say the total 8 waves will be there. This 8 waves will be consisting of 5 waves and 3 waves. 5 waves will be going in one direction and 3 waves will be going in the opposite direction. These 5 waves which are going in one direction will not be like say going up like this only. In that also, like this is going up and this is coming down. 3 waves are in the opposite direction. In that say these two are going down and this is going up. This is the way we will have the wave in the stock market. So again you have to recognize the proper wave and you should enter into the stock market and you should exit from the stock market. So just keeping that in mind, let us read this. Inspired by Dow Jones theory and by observations found throughout the nature, Ralph Elliott formulated Elliott wave theory in the year 1934. The theory was based on analysis of 75 years stock price movement and charts. From his studies, he defined price movement in terms of the waves. Okay, waves. According to this theory, named Elliott wave theory, Elliott found that market exhibited certain repeated patterns of waves. Repeated. For this 8, okay, this 8 is what you can understand, 5 and 3. As per this theory, a wave is a movement of the market price from one change in the direction to the next change in the same direction. These waves are resulted from buying and selling impulses emerging from the demand and the supply pressure on the market. Depending upon the demand and the supply pressure, waves are generated in the prices. As per this theory, waves can be classified into two parts, impulsive and corrective. Okay. Of course, friends, we understand it is impulsive and this is corrective. This is impulsive, this is corrective. Let us understand these patterns. Basic waves. In this pattern, there will be 3 or 5 waves in a given direction. It may be going upward or going downward. So it is 3 or it may be 5. These waves shall move in the direction of the basic movement. The movement can indicate bull or it may be bear. Okay, so this is what we understand is the impulsive wave 1, 3 and 5. That is what we understand. Corrective waves, that is so the reverse. These 3 waves are against the direction of the basic movement. So similar to the primary and the secondary movement. Correction involves correcting the earlier rise in case of the bull and fall in case of bear. So corrective is in the opposite direction. So correcting in the earlier rise, that is it will fall down and fall in case of the bear market. As shown in the diagram, 1, 3, 5 are directional movement. That is this 1, 3 and 5. So these are going up. Okay, this is going up. So this is the corrective movement, which are separated or corrected by second and fourth. So this is going down. This is second one and this is fourth one, termed as corrective movements. complete cycle. So now how the complete cycle is here? As shown in the following figure, 5 wave impulses is followed by 3 wave correction A, B and C to form a complete cycle of the 8 waves. So we understand that, say, this is 1, this is 3 and this is 5 going upward. This 2 and 4 are going downward. Now there are 3 waves which are going in the opposite direction. So this is what we understand is, say, 1. So it is 1 and 3 and the second one is going up. So this is impulsive, that is numbered, and corrective, that is the letter. So over here it is, what we can see, it is A, B and C. One complete cycle consists of waves made up of two distinct phases, bullish and bearish. On completion of one full cycle, that is termination of 8 waves movement, fresh cycle starts with the similar impulses arising out of the market trading. So what will happen once this 8 waves are completed, new 8 waves will start. That will be either bullish and bearish. Okay, bullish in like impulsive, then corrective in bearish, that is say the bullish in, that is impulsive, then bearish in corrective, or vice versa. Random walk theory. Friends, this theory is exactly the same as efficient market hypothesis. In that, say, whatever we have understood about the weak form of market efficiency, it is exactly the same. No change in that. Random means you cannot predict. Walk. So randomly you walk. So you may be going straight. So in which direction you are going to go, that you do not know. So basically this random walk theory or efficient market hypothesis says that all this technical analysis is useless. You will not be able to predict the prices. The prices can move in any direction. That is what this says. So keeping that in our mind, let us read this. While discussing the Dow Jones theory, we have seen that the theory is based on the assumption that the behavior of the stock market itself contains the trends which gives clues to the future behavior of the stock prices. Thus, supporters of the theory argue that the market prices can be predicted if their pattern can be properly understood. So this is what say the explanation of the above two. Such analysis of the stock market pattern is called technical analysis. Yes, that is what the heading. Apart from this theory, there are many approaches to the technical analysis. Most of them, however, involve a good deal of the subjective judgment. That's very true. Good deal of the subjective judgment. Because what will happen, friends, of course, all of you can very well understand that, say, whenever we are doing something like this, then you will not be able to have generally only one-sided view. I have already give you a kind of helicopter view that, say, there are a number of charts that we are going to discuss. So, of course, all these charts are not going to give you only one conclusion. That is, say, whether to buy the Reliance stock or not. So that question, if you ask to the 5 charts, then in that case, they will give you the different answers. So this is what they want to say, that this is subjective to a certain extent. Many investment managers and the stock market analysts believe that stock market prices can never be predicted because they are not a result of underlying factors but a mere statistical ups and downs. So there is nothing like trend. You just try to draw certain conclusions, but those conclusions are absolutely invalid. It happened coincidentally and it may not happen in future. This hypothesis, this theory is known as random walk hypothesis, which states that behavior of the stock market prices is absolutely unpredictable and there is no relationship between the present prices of the price and the future prices. Okay, you can connect with the weak form of market efficiency. Proponents of the hypothesis argue that stock market prices are independent. R is zero. A British statistician, Mr. M.G. Kednell, found that the changes in the security prices behave namely as if they are generated by suitably designed router wheel for which each outcome is statistically independent of the past history. This router wheel stands for, that's a, we know something like called uh, like if at all we visit a casino, then you can play a game in which I say that that ball may be placed into any of the number. You have to just guess that say my number will be, let us say, 81, and if at all that ball is going in the number 81, then in that case I'll get 100 times of the amount that I've invested, something like that. That is the router wheel. So do you know that say where the ball is going to be there? No. Similar is the case with the share price. In other words, the fact that say, there are peaks and troughs in the stock exchanges prices is mere statistical happening. So it happened just like that. Successive peak or troughs are unconnected. In layman's language, in a very simple language, it may be said that the prices on the stock exchange behave exactly the way, this is very funny, a drunk would behave while walking on a blind lane. So somebody who is drunk, that is ups and down, with an unsteady way of going in any direction he likes. So you never know that's where he is going to put his next, that is leg. Bending on the side once and on the other side second time. The supporters of the theory put a simple argument as follows. Price of the shares in the stock market can never be predicted. The reason is that the price trends are not the result of any underlying factors, but they represent the statistical expression of the past data. There may be periodical ups and downs in the stock market, but no connection can be established between the two successive peak, high price of the stock, and troughs, low price of the stock. Now, in this segment, we are going to learn only that how to draw the chart. We have been provided with the information about the line chart, bar chart, Japanese candlestick chart, point and figure chart. So these are the four types of chart. There are two types of question which I am anticipating. One is that so the question would provide you explain candlestick chart, and the second is that the question may provide you that say to give you explanation about the different kind of charts. If the question is that say you have to explain the different kind of chart, then in that case you need to remember all of them. That is the line chart, then point and figure chart, bar chart, and candlestick chart. Okay, that's very simple. Line chart is very simple. In line chart, lines are used to connect successive days prices. The closing price for each period is plotted as a point. These points are joined by line from the chart. The period may be a day, period may be a week or a month. So on the x-axis we take the time period and y-axis we take the price. That is parts of the line chart. Bar chart. Now basically what happens at say in case of the line chart, you can have only idea about the closing prices, how the closing prices are having the movement. Only that say you can come to know. Let us say that say we are having a discussion about the TCS security. So how the TCS security is having such a price variation, that you can come to know with respect to the closing prices. But what about the price of the security during the day? What was the highest price that it has achieved? What is the lowest price that it has gone? uh, what is the opening price? Say all that information you will not be able to gather. That is the reason say we have a bar chart over here. As far as the bar chart is concerned, listen carefully. The bar chart can be prepared for a specific time period. I am taking an example of 1 day. Listen carefully, I am taking the example of 1 day. So whatever the prices that say they have provided, with that I explain you how it is prepared. The opening price is 58, highest price is 72, lowest price is 52, and the closing price is 68. So in that case, the bar chart will be like this. This is 72, that is the highest price. This is 52, that is the lowest price. This is 58, that is opening price. And this is 68, that is the closing price. So I hope that everybody is clear. That say we will be having say the bar chart like this. This is the bar chart, wherein we understand that say this bar chart is indicating that this is the highest price, that is 72. This is the lowest price, 52. This is the opening price, 58. And this is the closing price, that is 68. This is what say we understand is the bar chart. So bar chart is drawn in this way: opening price, closing price, highest price, and the lowest price. So on daily basis, it is say drawn over here. In a bar chart, a vertical line, straight line, bar represents the lowest to the highest price, with a short horizontal lines protruding the bar representing both opening and the closing prices for the period. For example, the price of share of A Limited for the last 6 days are as follows. The above mentioned prices shall be cited in the bar as shown below. And friends, this is not necessary it is prepared for only 1 day. It can be prepared on the hourly basis. It can be prepared for every 15 minutes basis. It can be prepared on monthly basis, on weekly basis. For every minute it can be prepared. For every 10 minutes it can be prepared. It can be prepared for any time period. So during that time period, opening price is on the left hand side, closing price is on the right hand side, highest price is on the top, and the lowest price is on the bottom. Friends, we understand that say these points are fixed. On the left hand side only there will be opening price. On the right hand side only there will be a closing price. On the top only highest price. Bottom only the lowest price. These points are fixed. So it may happen that say we will be having a bar chart like this, wherein we understand that say this is the opening price, this is the closing price, this is the highest price, and this is the lowest price. Japanese candlestick chart. Now friends, what happens that's over here, uh, you need to take some additional pain to understand that say the closing price is more than opening, a closing price is less than opening. So we have a solution to this. The solution to this is working in this way. That say the chart is drawn like this. this is the candlestick chart wherein we understand that say this is the opening price, this is the closing price, this is low price, this is high price, this is opening price, this is close price, this is high and this is low. That is the way we have two types of Japanese candlestick chart. Let us understand that say this candlestick is indicating like this. Listen me carefully. This green candle or white candle, okay, it can be of the white color also, is indicating that the closing price is more than opening price. And this red candle is indicating the closing price is less than the opening price. That's it. Green color candle and red color candle. Green color candle is indicating that the closing is more than opening. And red color candle is indicating that the closing is less than opening. And this is called wick of the candle. Watt, okay, that wick of the candle. Wherein we understand that say this is the low price and this is high price. This is low price and this is high price. This is what we understand. Again, this can be prepared for any time period. Let us say it is prepared for 1 day, for example. Then in that case, how you have to interpret the candle? You have to understand it like this. At the start of the market, the opening price was this. End of the market, the closing price is this. During the day, the price went up to this. And during the day, the price went down till this. So the opening price, closing price. The market was opened at this price and the market closed at this price. During the day, the price went up to the high point over here. This is the high point. And it went down to this point. This is what we understand is a kind of the candlestick that say they have provided. And same is what we understand. This is the price at which the market was opened. The price of the security was there at the opening of the market. This is at the closing of the market. The price went up to this. It went down till this. This is given a name as the body of the candle. Okay. This is given a name as body of the candle. And it may happen like this. This is what we understand is a bullish candle. This is bearish candle. And it may happen that say we have something like this. This is called dodgy candle. Wherein we understand that so the opening and closing is same. The price went up and went down to this. This is dodgy candle. Like bar chart, this chart also shows same information. Opening, closing, highest, lowest of any stock on any day, but this chart more visualizes the trend as the change in the opening and the closing prices is indicated by the color of the candlestick. White and black. White means the green which I have shown to you. Black means the red which I have shown to you. Candlestick indicates the closing price is lower than the opening price, and white candlestick is indicating the opposite. That is closing price is higher than the opening price. So black candlestick is indicating that closing price is lower. It means bearish. That is the red one. And white is indicating bullish. That is the green one. Another possibility, no change in the opening and closing or very near as shown by doji candlestick, which I have shown to you last. This is the doji. Thus a white candlestick indicates bullish trend, black indicates bearish trend. The lowest and the highest prices are indicated by vertical bar, that is the wick of the candle, and opening and closing prices are shown in form of rectangle, that is body of the candle, above mentioned color scheme. Okay, that is the opening and closing body of the candle, which I had shown by way of the red and green color placed in between the bar. In case of doji candlestick, it is indicated by a simple bar, that is visible. Continue with the above example of A Limited. Prices of A Limited as per candlestick chart is shown below. Okay, this is white, that is indicating bullish, bullish. This is bearish, and this is the doji candle. That is on daily basis they have mentioned. However, it can be prepared for any other time period also. Next, point and figure chart. So it is similar to like the zero and cross game that say we were playing. It is similar to that. X is indicating bullish and 0 is indicating bearish. So now over here, as you can see that say we have a box over here. Okay, we have a box over here. How the boxes are supposed to be filled up, that is what I am explaining to you. The first thing is that say you have to determine that say what is the value of one box. You may assign a value of a box as 1 rupee. You may assign a value of a box 5 rupees. You may assign value of a box of 10 rupees, something like that. Anything you can assign a value. It means that unless, suppose you are having say a box value of rupees 10, it means that say you will not have anything to be placed say in this diagram, or we can say that in box you will not keep anything unless there is a variation of at least 10 rupees. Unless there is a variation of at least 10 rupees, you will not show anything. That is what's the first thing that you have to decide. Second thing that you have to understand that whenever there is a variation, which is more than or which is equal to the box size, only in that case you are required to put either a cross or you are required to mention 0. Third thing is that when the prices are moving unfavorably, means the prices are falling down, then in that case you have to decide that when you will put 0, you may decide that whatever is the box size into 3, that is what the amount by which the price reduces, then in that case you will put a 0 in the box. Or you may decide that this value into 5, so you will put 0 when the prices are going down by 50 rupees or more than that. This is the way you are required to put this diagram. Right now we are just understanding the diagram. No conclusion we are understanding. You can see that the above diagram also we have understood only. Point and figure chart are more complex than the line and bar chart. They are used to detect the reversal in the trend. So you can understand that when the trend is reversed. For plotting a point and a figure chart, we have to first decide box size. So what will be the value of one box? That you can keep anything. And the reversal criteria. And you have to decide that when you will put 0, you may keep any of the value. Suppose you have kept the box size as rupees 10 and the reversal size is 3 times of 10, or the reversal size is the 2 times of 10. That is what you have decided. Means you do not want to incorporate all the small fluctuations in your analysis. So these two things are required to be decided by you subjectively. I hope that everybody is able to make out this. The box size is the value of each box on the chart. For example, each box could be of rupee 1, it could be of rupee 2, it could be of 50 paise or any other. The smaller the box size, more sensitive would be the chart to price change. Of course, we can understand logically, you keep the box size of the lower value, then every time you have to incorporate the corrections. If you keep the box size more, then in that case you don't have to incorporate the changes number of times. The reversal criteria is the number of boxes required to be retraced to record the prices in the next column, okay, subsequent to this column, in the opposite direction. So over here, looking to the information, we can understand that say they have keep the boxes of rupee 1, okay, 22 rupees, 23 rupees, 24 rupees, 25 rupees. So they have kept the boxes as rupee 1. First day, let us say that the closing price is 24. So you have mentioned the X over here. Price increases to 26. So you have mentioned two crosses over here. Price increases to 27. Again you mention a cross. Price increases to 26. I'm sorry, decreases to 26. But there is no zero. Why? Because they must not have decided to incorporate the reversal in the sign if there is a change of rupee 1 only. They have not provided it, but this is what we understand with the diagram which they have drawn. Increases to 28. So from 26 it increases to 27 and 28. 28 to 27. So again you mention a cross. You mention, that is say you don't do anything. You don't mention 0 especially. Why? Because you have not decided to mention 0 until the price is falling at least by this amount. 27 to 26, no change. 26 to 25, you have not incorporated change. 25 to 26, you don't have show anything. Now, 26 to 23, there is a change of rupees 3 and you have decided to incorporate this. So, on 9th day, your X value was this. It reduces by 3. Now you think that it is a substantial decrease, so let me incorporate the same. So you mentioned 3 zeros. This is the way we are supposed to draw the point and figure chart. Usually it is kept of the 3 times.